Welcome back. 9 days, what can happen, right? Shows you how quickly things can change. So many of your companies that were overvalued before you left on the break might be undervalued now. Anybody valuing First Republic? Sure. Anybody valuing Silicon Valley Bank? That's kind of dead in the water. Now you might have to change companies. Now, but who knows? First Republic, by the end of this week, you might have to do your own set of gymnastics. But we're going to come back and talk about valuing banks, because I think that I tell people there's no sector I hate valuing more than banks. And you can see why, right? You can do an intrinsic valuation, but banking at its essence is built on trust. And if the trust goes, you can take the biggest bank in the world. We all decided that JP Morgan Chase is going to go down tomorrow. It'll go down tomorrow. Right? There is no bank that can sustain. In fact, it's the exact opposite of the Bitcoin universe, right? The Bitcoin universe is built on no trust at all. It creates incredibly inefficient mechanisms. We create trust mechanisms because it allows us convenience. Right? We leave our money in the bank. We don't think about it most of the time, unless it's in First Republic. Right now, and it's more than 50,000. No, but you don't think about it, which is the benefit of trust. It allows us to carry on business and go on with the rest of our lives. And you can see what happens if the trust gets shaken. And I think this time around, you have less trust to begin with, because 2008 was the original shakeup, and I don't think the trust has ever fully come back. So you can already see people's conspiracy theories that this has all been designed by the big banks to make the regional banks go down, that nothing can be trusted. It's a very dangerous place to be, not just for banks, but for an entire financial system. And this week is going to be interesting from that perspective in terms of how this plays out. If First Republic by Wednesday is acquired, does it stop there, or is there another bank that they will move on to? And at this stage, who benefits, who, what net, there can only be costs, even if some people benefit. So now we'll come back and address what to do if you're valuing a bank and you worry about trust being scarce. But today I want to talk about those last loose ends in intrinsic valuation, partly because I want you to be able to clean up your own intrinsic valuations. So let's start with our usual, start with the classics. Today, one of the things we're going to talk about is the difficulty of valuing. Some companies are more difficult to value than others. Why? Because they're complex, they're in multiple businesses, they're in multiple countries. So let's say you're comparing two companies. The first company is in a single business, has a very simple holding structure, and is transparent accounting. You know what I mean by transparent accounting? You read the financial statements, you actually understand what they're doing. The second company is opaque. It's in multiple businesses. It's a complex company. Forget about everything in valuation. Think like an investor. Simple company, complex company. Let's assume they have the same numbers, same growth rate, same cash flow, same, Which of these two companies would you value more highly? The simple company or the complex company? Someone put it to vote. How many of you value the simple company more highly because it's easier to understand? How many of you would value the complex company because you don't understand it very well? When I phrase it that way, it sounds weird, but nobody. If you open up any textbook and you start entering numbers, what are you going to find? Same cost of capital, same growth rate, same cash flows, you plug them in. Traditional valuation, we actually value simple and complex companies equally, and I think it's dangerous. We assume in valuation that what you don't know can't hurt you. Why? Because you average out. We assume that what you don't know cuts in both directions, and that's, I think, a key assumption. And that, I think, might be at the core of the problem, because what you don't know is more likely to be bad news or good news. Let me rephrase it. When was the last time you woke up to an accounting scandal where the company said, hey guys, we made 5 times more money than we told you we did? Notice, when you get a surprise, it's almost always that you lost money rather than made money. So we're going to come back and talk about what to do about complexity. I'll tell you when my wake-up moment on this issue came about. It wasn't right away. It took me a while to get there. But talk about the effect of complexity.
Can you assume that the marginal investor understands it better than people and therefore could diversify the unknown risk or complexity?
You're assuming the margin that's already priced in. Is that what you're saying? Because the marginal investor can't affect your value, they're priced today. The question is, how are you going to incorporate that in your value, right? So pricing.
Not in terms of pricing, in terms of like they understood it. Like if you don't understand, that's fine, but they understood it.
But if they don't fix it, you still have to bring it into your valuation, right? So if there's something bad going on, even if they understand and price it in, if you don't bring it into your intrinsic valuation, here's what's going to happen. You're going to come up with a value higher than the price, and you're going to buy the shares, right? So that might actually be the most dangerous scenario, because the marginal investor understands it and prices it in and lowers the price, and you're not bringing that in to your valuation. You're going to find these companies systematically undervalued. So it actually makes things worse when marginal investors can price it in. When everybody is completely confused, maybe you're in better shape because nobody really knows what's going on. So I think the most dangerous scenario is when insiders, it's not even marginal investors, when insiders know it and they basically price it in and push the price down, but you don't know it and you're still keeping the value elevated. So we'll come back and talk about the complexity issue. Here's the second issue I want you to think about. Okay? And this is something that right now, when you're talking about distress and liquidation, is worth thinking about. Let's suppose you do a discounted cash flow valuation of a company. I'm sorry. You do a discounted cash flow valuation of a company. You come up with a value of 100 million for the company. Let's suppose it has debt outstanding with a face value of 100 million, but the market value of this debt is 80 million. So think about what makes the market value less than the face value. And I ask you to estimate the value of equity in this company. So here are the choices. The value of equity is 0, in which case you're subtracting the face value of the debt from the estimated intrinsic value for the company. Or is it 20 million, which is so the real question I'm asking you, should I subtract out book value of debt, face value of debt, should I subtract out market value? I'm willing to listen to both sides. How many of you think I should be subtracting out the face value of the debt? Nobody? Everybody thinks we should, yeah.
Because they have to repay the face.
So that's the argument, right? I have to pay off the 100 million, so who cares what the market value
If they
is?
stand, it's not clear that they would be able to repurchase back at market price.
Let me play devil's advocate here. Right now, almost every company's market value of debt is lower than its book value, especially with its long-term debt. Why? Because they borrowed money in 2019, 2020. Right now, interest rates are much higher, right? So when I compute market value of debt, I'm still making my payments, but the present value of those payments at a 4% rate or a 5% rate is lower. So the reason the market value is lower than the book value is simply because interest rates have moved. I'm still allowing for the fact, I'm not saying I'm not paying, but I'm paying over time. I don't have to pay the 100 million right now. It's spread out over time. That's a good news. But what's the second scenario where market value is going to be lower than book value? It's got nothing to do with interest rates. If you're in bad shape, you get to be a distressed company, right? And then it gets more dangerous. Do you see why? Because if I subtract out the market value of debt for Bed Bath and Beyond, say, look, my equity looks good. All you need is somebody who's more creditworthy coming in and buying the company. Let's suppose somebody trusts my valuation, somebody's creditworthy, trusts my valuation, buys Bed Bath and Beyond for my estimated equity value. Guess what's going to happen to that market value of debt the minute the acquisition is done? It's going to shoot up to the book value because there goes. So you can already see that whether you subtract out market value of debt, especially when it's a big discount, most of the time it's not an issue. Market value, book value are close enough. But if they're different, you got to ask why is it different? It's purely interest rate movements. There's no distress issue. Stick with the market value because remember those higher interest rates are being incorporated into your DCF. How with the higher cost? So you're incorporating the effect. You have to be consistent. So what you subtract out to get to value of equity can sometimes be a little dicey, especially with distressed companies. Which brings me to my third and final thing that we're going to look at today. We're going to talk about stock-based compensation. It's become a big deal, right? Over the last 30 years, companies have increasingly shifted away from the traditional. In the 1980s, it was almost unheard of to give stock-based compensation. People are paid in salary, they got bonuses based on profitability, but stock-based compensation took off in the 90s. You know why it took off? The 1992 congressional compensation cap was written in terms of salaries and bonuses. Nobody thought about options, and all of a sudden it just took off after that. And it was aided and abetted by absolutely stupid accounting. And you're going to see in a minute what I mean by this. Let's assume your shareholders in a company. 100 million shares outstanding, trading at $10 per share. I decide to give 10 million options to my CEO. Why? Because I really like the guy. But to cushion the impact, I said, look, I'm going to set the strike price on these options equal to the current stock price. Then I said, don't worry, I've given away nothing. The exercise value is zero. Is that true though? So the value of the shares you had before I did this was $10. Now that I've granted these options, I'll give you the three choices. The first, you can go along with my sales, say nothing's happened, my value is still $10. How many of you would go with that? What's wrong with that argument? When was the last time you went to the CEO in the Chicago Board of Options, bought an at the money option and refused to pay, and actually got the options delivered, right? Just because an option is at the money doesn't mean it trades for nothing. There's a time premium on the option. When you give away options, you're giving away value. Whose value? They're giving away equity value. They're giving away a stake of your equity. And you can't cop up and use the third choice there. I'll wait till I see what happens because you've already paid the price. So you can't incorporate that into your value today. So today we're going to talk about stock-based compensation. How it started, primarily as management options, why it shifted away to restricted stock in most companies, and how to incorporate the effects into value. So we have lots on our agenda. Let's start with I think we were on page 229 of the slides, if you want to get on the same page, which I think would be a good idea. So last class, it was a long time ago, so let me review. We talked about what to do with cash. And what did we say we should do with cash when you have cash in the company? Most of the time I said do nothing, but there will be times when you discount cash in the hands of a company. And why is that? What's the reason for discounting cash in the hands of a company? What kinds of companies would you discount cash? Poorly managed companies, you don't trust the management of your cash. In some cases, you might attach a premium to the cash. Why? If it's a small company in an emerging market, it's capital restrictions. having cash will allow it to survive. But we said most of the time, don't play games with cash, but consider that possibility. With cross-holdings in a perfect world, what would you do? You'd value the parent company separately, each subsidiary separately, and then add up the pieces. Why don't we do it? First, it's a pain in the neck. You have 100 subsidiaries. Second, you need the information to be able to do it, and often that information is withheld. So you use shortcuts, use a price to book ratio, you apply a pricing to that to get to it. So today I want to talk about a third issue. You value the company, you've dealt with cash, you've dealt with cross holdings. Then you take a look at the balance sheet. Terrible mistake, because then you feel the urge to start adding other stuff. You know what I'm talking about? Because there are all these assets to get the balance sheet. You start with the most useless asset of all. Goodwill, what should I do with it? Just let it go. It's not an asset. But then you start to see assets that really have value. So let's suppose you're looking at a hotel company. Let's make it the Waldorf Astoria. You value the Waldorf Astoria. So what does it mean to value a hotel company? What do you have to do? You have to take the number of rooms in the hotel, estimate an occupancy rate, estimate a price. You do all this stuff right? Project out the income they're going to make as a hotel company, net of expenses, you get cash flows. You come up with a value of $500 million for the Waldorf Astoria. The Waldorf Astoria also sits on what, 4 blocks of New York City, some of the most valuable property. If you ask a real estate person, what will that real estate be worth? And he says, $750 million. So you got $500 million for your company as a hotel company, $750 million for the real estate. Can I add the two together and say the value of Waldorf Astoria is $1.25 billion? Why not? You can't have your cake and eat it too, right? You can't sell the real estate and say, guys, can I run a hotel on this real estate that doesn't? No, it doesn't work that way. The Plaza Hotel became essentially Plaza Apartments because somebody bought the hotel and converted to apartments. You can't have your cake and eat it too. So you got to pick one of the two numbers. So let me put you on the spot. You're an investor, and this is not uncommon. This is, I think, true for almost all 5-star hotels. You have a going concern value as a hotel company. You got a real estate value. And the real estate value is higher than the going concern value. Which one should you pick as your valuation? You have to invest in the shares of the company. Which one did you pick as your base value? Anybody want to get that a shot? And the reason is you don't, so the danger with going the higher of the two values is you don't run the company. So if they choose to run it as a hotel, you're stuck with the hotel cash flows. So if you don't control the company, you don't get to pick the higher of the two numbers. But if you could acquire the Waldorf Astoria, would your answer be different? Let's say you could buy the whole company. You'd get to decide what to do with it. Remember what I said about the Plaza? That's exactly what the Plaza buyers did, is they bought the company for more than what it was worth as a hotel, but less than what they thought was worth as real estate and apartments, and they converted it. You can already see this is one of those elements of control. The hotel business around the world, because real estate prices, especially in Asia, there isn't a single 5-star hotel I can think of in Asia that's worth more as a hotel than as real estate. It changes the game entirely because traders in these companies trade on the real estate. They don't trade on whether you're a good hotel company.
So the balance of the hotel will show the land as an asset.
Yeah, you can't count both. But what's the essence of discounted cash flow valuation? Who cares what's on the balance sheet? It's cash flows. What's that land used for? The building. What's the building used for? To get you those revenues. Once you do that, you can't count the land, you can't count the building, because that would be double counting. That's why when you value a shipping company, after you've done the value, you can't add the value of the ships and the value of the terminals because you can't count them both. You can count them separately. One is a liquidation value and one is a going concern value, but you can't count them both in the same valuation. So you think, what can I add on? Because you're desperate. You want to push the value up. In the 1990s, a lot of US companies had overfunded pension plans. Somebody help me out. There are two ways a pension plan can be structured in a company. One is defined benefit, the other is defined contribution. What's the difference between the two types of plans? What do you get in a defined benefit plan? A promise of fixed payments. I agree to pay $1,000 a month once you retire. A defined contribution plan, you put the money in, it gets invested in whatever, and you get whatever comes out of it. You can't have overfunding or underfunding with a defined contribution plan. But if you have a defined benefit plan, because you promised a fixed pension, whatever money you collect and you invest, if that money gets to go up in value higher than you expected, you have an overfunded pension. In theory, that belongs to the shareholders. You say, why in theory? You try to extract that from the pension plan, you can kiss neighbor peace goodbye for the next generation. So companies can't do it, and there's a tax consequence. You have to pay a hefty tax rate on it. But in the 1990s, a lot of companies had overfunded pension plans. You know why? So the .com stock price, it wasn't that they were doing something special. Stock prices went up, their pension plan values went up. And there were many analysts who added the overfunded pension portion to the value equity. I didn't like it then because 3 years later, you know what happened to that overfunded portion, right? Market collapse, and there went the overfunding. In general, I would not add it. It's not a good practice, but it's nice to have an overfunded pension plan because it allows you to set aside less in contributions, at least for the near term, to cover the difference. So what can you add? You're looking for completely what I call vacant assets. Assets that have value, but that you don't use for your operations. And it's tough to think of good examples. So I'm going to give you my favorite example. Anybody here part of the Michael Price fund? So I remember in 20 years ago, when Michael Price sold his mutual fund to the Japanese, I never involved myself with asking for money for this group. But one thing I absolutely refused to do. But in this case, I made an exception. They asked me, would you go meet Michael Price and ask him to fund this fund that MBAs can run as an investment fund? I said, okay, one time deal, never asked me again. So I went in, and of course he seeded the fund, and it's been run for the last 20 plus years. You can see the returns that you made over time. It's a rolling portfolio management, right? Because each class graduates, a new group comes in and runs it. And the Michael Price Fund is built on making pitches, basically. I don't know whether it's changed since. So, if you want to buy a stock, you got to pitch it to everybody else in the group, and they have to agree that that's a good investment to make, assuming you have the cash. So I've never officially involved myself with the fund, but about 15 years ago. Now, and a lot of people who go, are in the fund go through this class. About 15 years ago, sitting in my office, one of the people who's on the Michael Price Fund comes into my office. Now, I'm facing a conundrum. I very quickly turned to my computer, typed the word conundrum. No idea what he was talking about. But it was really another big word for confusion. So I said, okay, what's your conundrum? I like the word, I was going to use it on him as many times as I could. He said, my conundrum is I'm valuing Playboy. I said, I don't see a conundrum yet. He said, I've come up with a value of 240 million. It's trading at 300 million as a market cap. I said, I still don't see a conundrum. It looks overvalued. Let it go. He said, here's my conundrum. 7th time in the 3 minutes we had the conversation, the word comes out. He says, they have one big asset that they have that I haven't counted in the 240. What do you think he was talking about? Remember, the brand is what generates the Playboy bunnies, the brand. Those are what generate the cash flows. If I added the brand, that'd be double counted. What is it? The Playboy Mansion. The Playboy Mansion belongs to Playboy the company. And if you've ever driven by the Playboy Mansion in LA, it's a huge property, one of the most valuable properties in LA. It's worth about 150 million there. And the question he was asking is, can I add the 150 million to my 240 million? That's a conundrum. Why didn't come out and say that right off the top? I don't know. Which would make Playboy undervalued. I said, technically, yes, but you got a problem. You got an 80-year-old in a bathrobe hanging out there. You can't exactly throw him out onto the street. And I was talking about the fact that Hugh Hefner was still in the match. He said, what should I do? I said, why don't you check the actuarial tables? So what am I checking for? How long 80-year-olds who surround themselves with 26-year-old playmates tend to live. a lot of pressure on your heart, you could kick the bucket any day. Let's say in 5 years is what you come up. Then you know what you need to do, right? Take the value of the one mansion 5 years from now. Discount it back 5 years, you can get fancy and use a cost of capital in a real estate company for all I care. And add that on. I forgot all about this conversation until a few years later. I opened up the Wall Street Journal. And I said, remember I said you can't have your cake and eat it too? Playboy managed to have their cake and eat it too. They sold the mansion to a Greek billionaire with Hugh Hefner in it. I'm not kidding. The condition was that Hefner would continue to live in the mansion till he died. And then this guy, you say, why would I pay that? Well, I guess he wanted the glamour of the mansion, you know, reflected glory, whatever it is. Maybe he planned to wear a bathrobe and hang out in the mansion. He sold for 200 million. This is a truly vacant asset. So when you think about what can I add on, 5 years to add on things like brand name value. This is my worry with accounting doing what it is and bringing things onto the books is there's going to be this tendency to add on and double count things that are already in your cash flows. But if there are assets that are truly valuable, that are basically not unutilized now, but will never be utilized for this company, those are the kinds of assets you can add on because those are assets you haven't included. Any questions on other assets? So now let's turn to the complexity issue. Let's revisit that. Yeah. If it's underfunded, we have to talk about should we include it with debt, right? Because underfunding means it drains your equity value. You've got to come up with more. I'll give you 2 ways of dealing with underfunding in your discounted cash flow valuation. You can do one or the other, but you can't do both. So it'll be double counting. And you can start thinking already about the 2 ways that you can show it up. Right? One is you can show up as higher contributions you need to make, which will lower your cash flows in future years. The other is you can show it as debt outstanding today and subtracted debt. But I'm going to give you 2 rules on debt. One, when you do cost of capital. And there, I don't think you should include underfunded pension plans. And another in terms of the debt you subtract out to get to the value add. Now let's talk about simple versus complex assets. Let's make the example that I started the class with more tangible. 2 companies, exactly the same number, same cost of capital, same growth rate, same return on capital. But the first company is in a single business, it's a very simple holding structure. And is transparent accounting. The second company is in multiple businesses, has a complex holding structure. It has special purpose entities and all kinds of difficult to understand holding structures. And they have opaque accounting. You say, what's opaque accounting? This is an accounting statement that claims to be in English. Could you read it? But you have no idea what language it's in. Read it again. It's a language that only accountants or lawyers understand, which is inside accounting lawyers. The objective is to confuse you, not to inform. So one company is simple, and I think we kind of decided that the simple company should be worth. But I also made the confession that in traditional valuation, we make the assumption that what you don't know gets averaged out. For the first 10 or 12 years I taught this class, I went to the traditional assumption and said, don't worry about it. And then we had a company called Tyco have an accounting scandal. Those of you who don't remember Tyco was a conglomerate that grew through acquisitions, and they used the debris, accounting debris of acquisition. You know, when you do a acquisition, you have goodwill and restructuring charges to cover up a lot of bad stuff. And it eventually blew up and took Tyco down 80%. But that wasn't the story. When Tyco dropped by 80%, GE lost 15% of its value. You think, what's one company got to do with the other? How did I describe Tyco? A conglomerate that grew through acquisition. You see why GE was affected, right? Investors said, we got burned by Tyco. How do we know GE is not good? And I was teaching this class in the middle of a valuation class, and we brought this up, and I raised this issue. Should we be punishing companies for being difficult to understand, for being complex? And everybody said we should. And I said, okay. I lay out the groundwork on what we need to do. If we want to bring complexity into valuation, first we need a measure of complexity. We can't just say, I'll know it when I see it. So we need to measure complexity. And second, we need to bring that complexity into one of the numbers, the cash flows, the growth, or the discount rate. They all agreed. It's a great idea. They said, how should we measure complexity? And they looked at me and said, "You're teaching the class, why don't you come up with a measure?" So I did my first shot and they didn't like it. So the group of 200 MBAs and I think I was teaching in 260. And I said, here's how I'm going to measure complexity. I'm going to count the number of pages in the 10Q and the 10K. I know it's incredibly simplistic, but if there's a company you want to avoid valuing here, which is the company you least want to touch? I know which one I want to touch. The heck is it? 1,026 pages in a 10K. This is in War and Peace. This is how many pages it takes them to tell me what happened in 1 year. You're one heck of a screwed up company. It takes you 1,000 pages to get there. So I put this up and they look at me. At that time, they were paying $150,000 for an MBA. Now I'm sure the price has gone up. We're not paying $150,000 to count pages in a 10K. We want something more sophisticated. I said, you're right. What was I thinking? I'll be back next session. I came back next session with what I call my valuation shit list. These are all the things that bug me when I value a company and how much they bug me. And I created a spreadsheet to measure the bug out factor. So I'll give you examples of things that bug me. A company that claims to be geographically diversified but doesn't tell you where. Or they tell you where, but you don't just, you can't, you don't recognize any of the regions of the world. It's like a Lord of the Rings universe. I've never seen that. What is that? I still remember valuing BMW. They're claiming that 7% of their revenues came from Oceania. And I'm thinking my geography class, but I'm not American. What's Oceania? Maybe it's a lost continent of Atlantis. We're selling a lot of crypto. I called the investment relations officer for BMW. They said, it's Australia, New Zealand, Indonesia. They said, what do they share in common? They buy an ocean. I said, really? That's your definition of Oceania? If I use that definition, 80% of the world is Oceania, and what am I left with? Latvia? And a few other landlocked countries. But you can see when you mix together Australia and Indonesia in the same group, you see the problem you're going to create? How do you come up with an equity risk premium that captures both countries? We use the example of, remember EMEA? We talked about this. So I took all these things that bug me, came up with a score, and I said the higher the score, the more complex the company. But do you like this more? And they said, yes, this is so much better. This is why we pay $150,000 for an MBA. I said, it does come with a small cost or a big cost. To come up with the score for Citigroup, what do I need to do? Read 1,026 pages. I said, I'm in no mood to do that, but each of you is valuing a company this semester, right? They could see the train coming at them down the track. Too late to get out of the way. They should have picked the number of pages I gave them as an option. They said, yes. And I said, this semester, in addition to valuing a company, why don't you come up with a complexity score? It wasn't a question. It was actually an edict. They bitched and they moaned, but what choice did they have? So that semester, in addition to valuing the company, they could come in with a complexity score. It's good that I did that because we learned some very interesting things. First, there seemed to be no correlation between company size and complexity. Going in, I thought big companies would be complex. In fact, there were small companies that were incredibly complex and big companies were incredibly simple. Second, emerging market companies are about 20 to 30% more complex than developed market companies, usually because of cross-holding structures, a lot of family group companies. Third, any company that grew through acquisitions was almost automatically 30 to 40% more complex. And some of you might be finding this out the hard way because you picked a company that goes through acquisitions. It's much more difficult to do valuation because acquisitions tend to be lumpy. You do an acquisition, you don't do one, it's 2 years. And finally, they found that any company with a financing arm was significantly more complex than a company without one. You know what I'm talking about, right? GM, GMAC, Ford Capital. You're saying, what's wrong with that? You've taken a bag and put it right in the middle of a manufacturing company and said, trust me, all the debt belongs to the bank. How the heck do I know? So they came up with complexity scores. The most complex company in the class that semester was GE, Hyundai Heavy, the Korean company, but it was GE. I've told people, look, if I become the devil, and my job is to deal with all the investment bankers who get sent out to hell, Here's what I would do. I'd make them value G, it'd be like Groundhog Day, value G for the rest of eternity. Day in and day out. It's my definite, and this is the OG. Now with the G, you see the pay limitations that OG, 26 different businesses, 72 different countries, growth through acquisitions. If you think about loading up every conceivable bad thing in valuation to a company, G had it. So you can go with the simplistic measure of counting the pages. It's incredibly effective. Now you might count the megabytes that a PDF file is. The problem is you have pictures that kind of loads it up, but you can convert it to pages. It's actually very effective. Or you can go with a more focused measure of complexity where you bring in all these issues. But once you've measured complexity, you still have a task to do, right? You got to bring it into one of the numbers. Remember, we said the it proposition, if it does not affect the cash flows and it doesn't affect the risk, it can't affect value. So I'll give you the choices. One is, you can do what some analysts did in the late 90s, ignore complexity. In the good times, this tends to happen. People ignore it because they assume what you don't know can't hurt you. Then you go to the other extreme. In a crisis, you completely act like all these things are worth nothing. So all these other assets are worth nothing. But the middle ground is you have to do your job and try to bring it into one of the areas. So here are the choices. You can adjust the cash flows, haircut the cash flows. You know what haircutting the cash flows is? You take your expected cash flows, you knock them down. The problem is how much you knock them down is kind of arbitrary. But if it's a more complex companies, I would lower the cash flows. Second is you can adjust the discount rate. Maybe you can use a higher cost of capital. You think how much higher? Here I can give you some guidance. Remember I said each month I picked a different loose end. I spent a month on complexity. I actually took the S&P 500 and I split it down the middle. 250 complex companies, some judgment calls there, 250 simple, 250 complex companies. For how I computed implied cost of equity for the S&P 500, I took the index level cash flows. I did that for each half. The implied cost of equity for complex companies was about 1% higher than the implied cost of equity for simple companies. You can then say, okay, I'm going to compute a cost of capital, risk-free rate plus beta times risk premium. It's a complex company, and add an extra 1%. Higher discount rates, lower value for complex companies. The third is, and this is my favorite device, is remember for growth to create value, you have to earn more than your cost of capital. So when I value an Amgen, and I see a return on capital higher than the cost of capital, I'm pretty comfortable assuming they can keep doing it because I can see where the excess returns come from. It comes from the fact that they're protected from competition. They have a blockbuster drug. I can see what's driving the excess return. But if you value a company that makes well above its cost of capital, you have no idea what they do or how they make money. Then my suggestion is bring those excess returns down to zero very quickly. Because you don't know how they're making excess returns, assuming they can keep doing that magical thing for the long term can totally get you into trouble. In the late 90s, one of the companies people used to pick to value this class was a star company of those days, Enron. And to a person, every person who picked Enron to value come into my office and say, this company makes billions, but I have no idea what they do. They claim to be energy traders, but what does that even mean? Who are you buying the power from? Who are you selling it to? Why are you be able to make all this money? Did all these special purpose entities throwing off profits? You had no idea what they did. So what should I do? And this was well before we knew about the fraud at the heart. I said, look, if you don't know how they make money, you can't assume they can keep making that for the long term. Bring the excess returns down to zero. And the minute you did that, there was no way you were going to find Enron to be undervalued. So use that as a technique to kind of bring it. So whatever you do, if you decide that your company is deserving of that punishment, there's a place to show. But it might also show up in that final judgment you make. You find a company to be undervalued, you get ready to buy it. It's a complex company with a lot I don't know. Remember, the danger of doing that is, especially if you have doubts, this becomes a way you can hide behind those doubts. As a final part of the month, I think the last couple of days of the month, I took the 100 largest market cap companies in the US. And I ran a regression of price to book ratios for these companies against return, equity, beta, and growth. Three classic variables that always drive price. But I also threw in the number of pages in the 10K into the regression. Somebody help me out here. How do I read this minus 0.003 on the number of pages? What is it telling me about price to book ratios of companies?
The number of pages goes up. The price goes
For every 100 additional pages in your 10K, your price to book ratio drops by 0.30. You want to set up a consulting firm? Value Consulting Incorporated. Citicorp is your first client. They walk in and say, our price to book ratio is only 0.9. How do we double it? Easy, right? Knock 300 pages off your 10K. Sounds facetious, but remember, Citigroup had 1,000 pages in its 10K by design. It started the day Citicorp, a bank, bought Travelers Group, an insurance company, and decided to become a financial supermarket that would do everything. So what's this regression saying? Hey, simplify. The market doesn't understand you. And this is advice I would dish out to every money center bank today. I think money center banks have become nightmares to bank. There are too many unknowns, too many pieces of the puzzle that are opaque. And my suggestion with banks is simplify. JP Morgan would be worth more broken up into parts, into banking, and it'll never happen because JP Diamond once ruled the empire. But I think money center banks have just become too incredibly messy to value because there's too much you don't know. Let's talk about that. There are two places in valuation you're going to run into the debt. The first is when you do cost of capital, right? You need a debt to do cost of capital. The second place is you need a debt to subtract out once you get the firm value to get the value added. And I'm going to give you two different sets of rules for the two cases. When you do cost of capital, the debt you should use, you should be circumspect about your definition of debt. Your definition of debt should include all interest-bearing liabilities and lease commitment, and you should stop there. As opposed to doing what? You're going to see other stuff showing up in the balance sheet. Underfunded pension obligation. You're going to be tempted because the conservative part of you says, bring that into debt. But the reason you should be careful is if you bring all of that stuff into debt, you're going to make your debt ratio higher. What are you going to do to your cost of capital? You're actually going to make your cost of capital lower. So when you do cost of capital, keep your debt definition narrow. All interest-bearing debt, lease commitments, stop right there. See, but I'm worried. I'm worried I have underfunded pension obligations. I'm worried because I'm in a target of a lawsuit that I could lose. When you get to subtract out the debt, then the rules change. The first is when you talk about book value or market value, the rule that I stated earlier kicks in. If the market value of debt is lower than the book value simply because of interest rate movement, stay with the market value. There's really no upside to going with book value. But if the market value of debt is lower than the book value of debt because there's distress in your company, you got to be cautious. Because whatever equity value you see could be a mirage. Because the minute that creditworthiness comes back, the debt is going to bounce back in value. And you could be left with equity worth more. But this is your last chance, right? To deal with anything else that worries you. So if you do have underfunded pension obligations, this is your chance to subtract it out. Say, look, I'm going to take it out of my value of equity because I need to come up with this money. Unless, of course, you can get the government to pick it up. And remember, a lot of big companies, most companies no longer offer defined benefit plans. This is the legacy of the 20th century. And many of those companies, especially the automobile companies, have looked to the government for a bailout. But if you don't get that, it has to come out of equity investors. You subtract it out. But there's a trickier component, which is if your company is targeting a lawsuit, let me rephrase that. If you're a US company, when your company is targeting a lawsuit, it's not a question of if. You got to worry about what will that do to equity. Now, if you've been investing in tobacco companies for the last 30 years, this has been front and center. Why? Because tobacco companies have this effect hanging over them of, at least for the first half of these last 30 years, of lawsuits against them because of cancer that could be 5 billion, 6 billion, 8 billion payouts. I'll talk about what happened midway through. But for the 1990s, if you had a tobacco company, almost every single one of them would look undervalued. Not pure. Until you brought the fact that there are all these lawsuits out there, and if I lose them, I could end up losing 10 billion, 15 billion, 20 billion. So what should you do with those? Find a good trial lawyer. This has nothing to do with the economics, because now you're talking about what is the chance I will lose a lawsuit, what will the appeals process look like, what will the end payment look like, and bring it through. What happened in the middle of the 30 years was it was Congress actually offered the tobacco companies a deal where they paid tens of billions of dollars into a fund, and they were relieved of much of the lawsuit liability that they would have. So that's actually an easier problem, because now the money's actually been made tangible, you know exactly how much to subtract out. And it's not just tobacco companies. For about 4 or 5 years, Merck's stock price was driven by Vioxx lawsuits. Remember 2007, 2008, you had all these cases of Vioxx creating side effects, billions of dollars in payments. Or for the last 5 years, what happened in Bayer, the German, chemical company, because it bought Monsanto, and one of the worst acquisitions of all time. The CEO of Bayer should never be allowed to run another company ever again after that acquisition. Because when they bought Monsanto, they bought themselves a Roundup lawsuit, which in a sense could potentially bankrupt anyone. I think they've eventually figured out some kind of, payout, tens of millions of dollars. But until that payout comes, you have to assess the likelihood of losing the lawsuit and what you will have to pay because of that. What I'm trying to say, whatever worries you have, this is your last chance to deal with it, right? Whether it's regulatory payments you might have to make, lawsuits you could lose, or underfunded healthcare or pension obligations, bring them out to get to the bank. Which brings us to the last two sectors, which is stock-based compensation and what to do. Stock-based compensation, before we get any deeper, you know that I think, was it last year that Amazon was the largest, maybe 2 years ago. This used to be a school where almost everybody ended up on Wall Street. It was a trader school, right? You ended at Goldman's, and those days have shifted. So I think about 2 years ago, the largest employer here was Amazon. Increasingly, tech companies are competing with banks at the top business schools. And many of these tech companies are younger tech companies, lots of promise, the Ubers of the world, the snowflakes. There's a long lead in here. But why do companies use stock-based compensation? Because they don't have cash. You could give this long-winded incentive. It has nothing to do with making incentives match up. It's because they don't have the cash. A snowflake cannot compete against a Goldman Sachs and pay you $300,000 a year because they don't have $300,000 in cash. So what do? They offer you $100,000 a year plus stock options, $100,000 a year plus restricted stock. This is not bad. It's because so they're using stock-based compensation as part of compensation factors. Told it was a long lead. What do we do with the rest of compensation expenses? We treat them as cost of goods sold, come up with operating. So if you use stock-based compensation, what should you do? The logic is impeccable. You need to be treating them like expenses. Finally, accountants are doing this, but for the longest time they didn't. But they are expenses, and because they're expenses, they lower your income. The fact that they're non-cash is neither here nor there. They're in-kind expenses, like running a pizza store, where because you don't have the cash, you hand out whole pizzas to your employees and take them home. Say, no cost. There's a cost. So let's get that out of the way. There are two big questions we have in stock-based compensation. One is, what do we do about past grants of stock? Because your company's been giving out options and restricted stock for as long as it's been on the face of the earth. What do we do with that deadweight cost that's hanging over you? And what do we do about the fact that they're not done yet, and they want to keep doing this in the future? And I want to deal with the question separately, but I also want to deal with the two forms in stock-based compensation. Starting in about 2007 and 2008, increasingly stock-based compensation has taken the form of restricted stock. You say, what is restricted stock? There's shares in a company that come with a restriction. The restriction is you cannot trade those shares or sell those shares for X number of years. First, you have to vest. In most companies, you have to stay with the company for a period of time before those. But once you're vested, you still might not be able to trade the shares for 3 or 4 or 5 years. That's the restricted shares. The shares without liquidity. But they're effectively shares in the company. Why is this an easy problem to deal with? If a company grants restricted shares, you know what I'm going to do? I'm going to count it as part of my share count. And I'm done. The fact that they might be slightly less valuable because of the lack of liquidity, I'm not going to make a big deal about it because you can always go and borrow against market value of the shares and hope and pray the market value doesn't collapse. Restricted shares are an easier problem because they're like any other shares. The messier problem is when you give out options. Remember the example I gave to you, which is, you grant options, they're at the money. You say, what's the big deal? Right now, it's not a big deal, right? But some of them will get exercised. And what are the conditions under which options get exercised? The share price goes up or the share price goes down? It goes up and they get exercised, and they get exercised at a price lower than the stock price. That's really at the core of the problem. Is not that you're giving away shares, they're giving away shares at a discount in the future. You think, but they could end up being at a premium. It's true, right? But there are options. You can't go and collect that. So you can't go to the management and say, buy the shares at the lower price. It's a one-way deal. So I want to talk about the options part because the options have to be dealt with in one of two ways. One is that you let the people exercise at the prevailing market price, which is going to create a dilution effect, right? Because they're going to buy the shares at a 30% discount or a 40% discount of the stock price. What's the other? What do companies do? They buy back shares and they hold the shares for, but either way it hurts you, right? That buyback comes out of your cash flow. So there's no escape hatch here. As equity investors, one way or the other, you're going to pay for these options. So I'm going to start with a very simplistic example of options, give you the three ways in which analysts deal with options, ranging from what I call the bludgeon approach, which is what most analysts use, to a treasury stock approach, which has its own flaws, to what I think is the right way to deal with options. So let's set up the example. Let's assume you have 100 million in free cash flows of the firm and a cost of capital of 8% and 100 million shares outstanding and $1 billion in debt. So first I'm going to value the firm. 100 million cash flows, 8% cost of capital, 3% growth rate gives me a value for the firm of 2 billion. I subtract out the debt, I get a value of the equity of $1 billion. I divide by the number of shares, I get $10 per share. So this is a traditional DCF. Now I'm going to rock the boat by granting 10 million at the money options to my CEO. And this was the question I asked you, what will happen to the value per share? And of course, the accountants until 2007 would have said, don't worry, these options are worth nothing because they're at the money. The value per share should be unaffected. You can already see the logic doesn't work out, but that was the sales pitch. The second is options do affect your value, but the question is by how much? The bludgeon approach is what you do. You take the 10 million, you add it onto the 100, it's called the fully diluted approach. You take the total number of shares, you divide the billion by the 110 million, say my share price value should go down by about 10%. Why is it the bludgeon approach? Because when you exercise these options, cash comes into the company, right? You're ignoring that when you just adjust the number of shares for options on this value. So I'll give you a way of getting around it. It seems like an easy fix, but then we'll talk about the right way to deal with options. So I'm going to take you through three approaches for dealing with options. As I said, I'll take the bludgeon approach first. You take the billion, you divide by the total number of shares outstanding with the 10 million options included. You come up with a value per share of $9.09. The reason you're overstating the effect of the value of your equity is you're ignoring the cash that's going to come in when these options get exercised. So it's an easy way to fix that. When these options get exercised, 10 million options, you're going to get $100 million in cash coming in, right? So the second approach, here's what I do. I take the 100 million that I'm going to get from the exercise of these options, and I'm going to add that on to the billion, which gives me, in this case, extra $100 million in cash. You divide by the number of shares, and this is almost magical. The value per share remains unchanged. Already you can see what the treasury stock approach assumes, right? It ignores the time premium of the options. So the bludgeon approach understates the value of your equity because you're just adjusting the number of shares. The treasury stock approach overstates the value of your equity because you're ignoring the time premium. There must be a Goldilocks solution, which is we can bring the time premium of the options in. I should be able to get a much better sense of the value of the equity. What does that mean? How do we bring in the time premium in option? Well, until 1971, that's what you had to do. But starting in 1971, option pricing models do exactly that. They bring in the time premium of the option by incorporating the fact that there's variance in the stock price and therefore there's an upside. So the third approach, what you do is you value the options as options. Sounds like a weird thing to say, but you value them as options, not based on exercise value. You look at the remaining time left of the option, the variance of the stock price. You value the options as options. You subtract that value from your equity value. Do you see why? Because those options are a piece of your equity you gave away. And then you divide whatever's left over by the 100 million shares, the original shares. So you don't make gains with the share count. Options are not 0-1 securities, where they're not shares until they're exercised. They're intermediate securities. And this way you bring that in to the value of the options. All I need to do is take these options and apply an option pricing, right? And we've got option pricing models. And option pricing models are actually, among all valuation models, the ones that are most precise because most of the inputs are given. The S, the K, the R, the T, maybe the sigma has to be estimated because it's a derivative security. But there's one catch. The original option pricing models were designed to value options listed on the Chicago Board of Options, listed options. And let's go through those characteristics. Those listed options tend to be short term. So option pricing models are designed to value 2-month, 3-month, 6-week options. Employee options are long term. You're saying, so what? The assumption that the variance will not change might not be a big deal with a 3-month option, but with a 10-year option, much more dangerous. Second, when you buy an option on the Chicago Board of Options and you exercise it, the company has nothing to do with it, right? It's somebody on the other side. So the winners and losers, but the company is assigned there. But when you have employee options, they get exercised, the share count actually changes. The very act of exercising options can affect the stock price. Can you imagine that CEO with 10 million options exercising the option, the stock price goes to 18. The minute that exercise happens, there's going to be a dilution effect. And third, with listed options, you almost never get early exercise. Why is that? If you buy a call option in IBM or in Microsoft, and let's say the stock price goes up, you guessed right? But rather than exercise the option, what's almost always more optimal to do? Sell the option because there's a time premium on the option, which means you can value these options using what are called European option pricing models, which is what the traditional Black-Scholes is, because nobody exercises before expiration, or very few people. Can you do the same thing with employee options? Let's say you're an employee at Tesla. Became an employee, the market cap is 150 billion. The market cap goes to 1.2 trillion. You know this is too good to be true. Can you sell your options? Employee options are not tradable. And people have tried to set up trading platforms, but the companies come down on it very strongly. They're not tradable. You know what's going to happen, right? If the stock price gets to 1.2 trillion, you think it's too high because you can't sell the option and you still want to cash out. What do? You get early exercise. So 3 places where employee options become more difficult, they're more long-term than a typical listed option. Exercising them can create a dilution effect. And most of them get exercised before expiration. But those are fixable problems. You can take an option pricing model and adjust it for the dilution. And to explain what this means, here's what I'm going to do. If you take the stock price of $10 and the strike price of $10, the example that I just gave, the option looks like it's at the money. But if I adjust for the fact that exercising this option will create dilution, the stock price gets adjusted down to 958. Essentially, I'm adjusting for the expected dilution of the option, which will lower the value of the call option. If I'm worried about early exercise, I can take a maturity and maybe even use a 5-year maturity. In fact, I tend to use half of the average maturity of employee options when I value the options, because options get exercised about halfway through maturity for most of these companies. Both those adjustments are going to lower the value of the option, but there's still going to be an option value. Here, the option value that I ended up with for this option was $5.42. Remember, I gave away 10 million options. That's $54.2 million that I've given away to VC. You get a chance, take a look at the option grant that the Tesla board gave Elon Musk in 2018. It's the most astonishingly large option grant I've ever seen a board grant. It was triggered by what the stock price had to be. So it's not like they were not rewarding him for doing the right thing. Just the magnitude of the number of options we get, which translates into billions of dollars, not hundreds of millions, billions of dollars. But basically, that's what we're trying to do. So now I'm ready to do the right thing. So I'm going to go back to my original example. Remember, I valued the equity at $1 million. I'm going to subtract out the value of the option, the 54.2 million. I'm going to come up with 945.8 million. And I'm going to divide that 945.8 million by the 100 million shares outstanding to come up with the value per share of $9.46. You think, when will that happen? Instantaneous. The minute the company announces it's giving 10 million options at the money, you're going to see the stock price drop, because as a forward-looking shareholder, I've got to bring that into my value per share today. Say, look, you just gave away something of value, and I've estimated what you're going to do at 54 million. That's $54 million less for me. Now let's talk a little bit about what accountants used to do and what they do now, and how that might explain the shift to restricted stock. I told you options took off in 1992. Tens of millions, tech company boom, the dot-com boom, everybody gave options. They were free currency. And accountants aided and abetted them by saying, if you grant at the money options, it's a zero expense. So you see why companies give away millions. Then after the fact, 3 years later, you get these options being exercised. Oh my God, the CEO got a $350 million package. It took 15 years to convince accountants to do the right thing. Starting in 2007, when you give options, you got to value the options using an option pricing model. It's now become part of the toolkit for anybody who does accounting now. You've got to be able to value the options. You've got to show it as expenses in the year that you grant the options. And all of a sudden, the magic and the freeness of options disappeared. And that's when you saw the shift to restricted stock. But to show you that you can lead a horse to the water and try to make it drink. What do analysts do? The accountants are now doing the right thing, right? They're treating stock-based compensation as an expense, reducing the earnings. And what do analysts do? They reverse the whole damn thing. We sometimes wonder, they do the same thing with leases. I mean, stupidity must be just built in so deep into their thought processes that they continue to reverse things that are the right thing. So maybe we should just let accountants do the wrong thing, because analysts don't seem to care. So when you think about what to do with options, essentially treat them as a grant of equity, and you're very quickly going to see a pathway to the right thing. So that takes care of the deadweight cost of options in the past. You're saying, what about the fact that companies can grant options in the future? Do the right thing. You said options are compensation expenses. If you expect your company to continue to grant options in the future, you know what you should do? Show it as an expense, lower your income. Don't add it back as a non-cash expense. It's an in-kind expense. It'll lower your future earnings and cash flows. And the reason I would separate the two is there are some companies that used to give stock-based compensation a lot and have stopped for the most part. Some companies that used to give stock-based compensation in the past will continue to do so in the future. And some companies which have never granted stock-based compensation in the past, but might do so in the future. So you have to deal with two separate problems. One is stock-based compensation in the past, and the other is stock-based compensation in the future. Both will lower the value of your equity. You're not double counting. You're counting for two different effects. So any questions on stock-based compensation? So we're done with the mechanics of valuation. I'm going to return back to a theme that I started this class with, that every valuation is a story. It's and the way I describe it, valuation is the bridge between stories and numbers. So let me start to add some flesh to that story. Left to our own devices, we're going to go to our preferred spot. So if you're a number cruncher, you're going to go with the number crunching, you're going to build Excel spreadsheets, you're going to make them more and more complex. If you're a storyteller, you're going to tell bigger and bigger stories. And left to our own devices, we're going to operate under our own delusions. So this is a pushback on working on your weeks. So what I'd like to do is take you through the process of going from story to numbers. And this is a process I go through on almost every one of my valuations. And the reason I'm going through it is because I have to teach myself this process, because I'm a natural number cruncher. I feel the urge to open spreadsheets and compute ratios, and I have to slow the process down and say, you've got to go through this process. So there's no magic to this process. You don't have to follow the same process. You got to figure out your own way to bring in both sides. So here's the first step when I sit down to value a company, whether it's Snowflake or whether it's Amazon or whether it's JP Morgan Chase. The first step is what I call surveying the landscape, understanding your company, the business it's in, the competition. It's not magic. You can't value a company if you don't know what it does, if you don't know what the market it's serving is, and what the competition is. So what I'm going to use to illustrate this process is a company that I valued 10 years ago, where I learned a great deal more about storytelling and connecting to numbers than any other company I've had. So valuation I did of Uber in June of 2013. We lay the groundwork. What triggered my interest in Uber was a Wall Street Journal story that Uber had raised money from venture capitalists who had priced the company at 17 billion. And I make a confession. I'd never heard of Uber. Can you not hear of Uber? Do you live underground? Technically, I did. I took the subway everywhere. I never took car service. No. I thought, no, but let me take that back. I said I'd never heard of Uber. That's not technically true because my son, who was going to college in North Carolina, was using Uber, using my credit card to back up whatever he was doing in Uber. But I thought he was taking German language classes. The no rule out on the you should have taken her away. So but I look at them and say, this company, what does it do? So my task is laid out for me, right? I can't value the company if I don't know what it does. So guess who I called first? My son. But he was sleeping. It's only 11:30 in the morning. But he kept what I call college student hours, which have nothing to do with the sun coming up and the sun going down. It's got to do with whenever the bars close and whenever you go to bed. And he wouldn't pick up his phone. So I called my niece, who lived and worked in Chicago, and she was technically awake. Why? What am I take? She was at the desk, horrible mood, clearly because she hadn't slept a good night. And her first response when she picked up the phone, what do you want? This is how she greets her favorite uncle. And I said, this company called Uber. She said, it's a ride-sharing company. I said, what the heck is a ride-sharing company? She said, I don't have the time to talk to you right now. Why don't you download the app and find out for yourself? Hangs up the phone. Talk to her mother about this behavior. But I did download the app, sitting in my office upstairs. Hit the app, magical things start to happen. A GPS opens up and I see a car trying to drive towards me. Why? In New York City, you don't get from point A to point B, you just travel. With zigging and zagging, all these one-way streets, closed streets. And I can see the name in the car. It says George. I've never seen this with the yellow cab. Fascinated. I want George and his car navigate their way in front of 44 West 4th Street. I run out, there's a hi, George. He says, you didn't enter a destination. Where do you want to go? I said, nowhere in particular. Can you drive me for about 30 minutes? I have some questions to ask. He thought I was a serial killer for a moment, but then he said, you know what, you're small enough, I can take you, get in the back seat. So I started asking questions. I said, the Uber car you're driving. He said, no, this is my car. I said, but you must be an Uber employee, right? He said, I'm an independent contractor. I said, what do you do this? He said, I have a regular job, but I don't make enough money at it. I already own this car, I pay insurance, and this allows me to earn a second income that supplements my base income. That's interesting, but why do you need Uber? He said, in New York City, it's illegal to stop on the streets and offer somebody a ride. And that's actually true. There's all these rules against gypsy cabs. He said, Uber connects me with customers. So that's interesting. And now I could understand why this guy drove Uber. So 30 minutes later, he drops me off and I offered to pay him. He says, you don't have to pay me. I said, it's free. I said, it's not free. When you download the app and they ask you for a credit card. I said, yes. They'll charge you. So how do you get paid? They give me 20%. I mean, they give me 80% of the fare. I still remember asking, why 80%? He said, I don't know. That's what they already drives off. At this stage, I could see why Uber did what they did. For connecting cars to customers, they got to keep, that's a sweet business to be in. Which left me with one final question. Why do people like my son and my niece like Uber? So I called my son again at college. He said, this time at 3:30 in the afternoon, no excuse to sleeping still. See, he's awake, and I put him on the defensive right away. I said, you own a car at college. Why do you need to use a ride? I acted like I knew what Uber was right from the beginning. Why do you want to use a ride sharing service? He says, Dad, on Friday nights and Saturday nights, I really like Uber. Now, there are some follow-up questions you don't ask as a parent. I kind of got it. I said, I mean, this is a kid who would never call a yellow cab. It's not even in his frame of reference. I said, what do you like about Uber? He said, I can call the car from the bar. I said, that's a plus. It must wait forever, right? You know, they come sooner than a cab. It's cost a lot more, right? He said, they're cheaper than a cab. The cars must be filthy, right? No, they're cleaner than a cab. I said, let me get this straight. They come sooner than a cab, they're cheaper than a cab, and they're cleaner than a cab. I knew that cab service was destined for doom. The convenience, the fact that, I mean, let's face it, the yellow cab system is it's not even a 20th century system, it's a 19th century system, right? I can almost visualize people calling horse carriages in the 1800s, hey, come on over. That's how you call a yellow cab. Which left me with one final question. What's so special about Uber? Why couldn't I go down into my basement? It's an intermediary, get a big computer, connect cars to customers. And I can think of two things that Uber had that I did. One was $3 billion, which is what they raised from the VC. They had it, I did not. A little bit of a disadvantage there. The second is, this is the business with networking benefits. It's kind of a buzzword used, but you know what that means, right? Usually as companies get bigger, it gets more difficult to get the extra customer. You got to work hard. With companies with networking benefits, as you get bigger, it gets easier to get that extra customer because you go where the action is. If you're a driver, you drive for the biggest ride-sharing company. If you're a customer, you download the app for the biggest ride-sharing company because it's where you're going to get the most cars. That was my research on Uber. You say, why don't you look at the financials? What financials? Uber was a privately owned company with almost nothing publicly available. The only thing I knew about Uber was how much they had as gross billings leading in and how much money they lost. And those were leaked by in a VC presentation somewhere. What I'm trying to say is, even if I had access to all of the financials at Uber, what would I have learned? Small revenues, big losses. There's not much you learn about young companies by looking at their financials, because it's all about the market they're serving, the product they're offering, what they're. So here's what I did after this research, if you can call it that. I drew a picture, and I tried to do this and this is what I tried with the Silicon Valley Bank, right? It's a good way of saying all these stories are milling around. I want to make sense of what's going on here. I drew a picture of what I've learned from my son, my niece, from talking to the Uber driver. I've learned more about Uber by talking to Uber drivers around the world. I know they all collectively probably hate me because when I get in the car, listen, what does Uber look like? Who do you compete with? Why do you like Uber as opposed to Lyft? Why do you drive for one? Because I get much more information from those drivers than I would ever get from the top executives. So I drew a picture basically of how Uber made money. They're an intermediary. What made them special, the networking benefits. And essentially it became the platform that I used to value the company. So that's the first step, is understand the business you're in, because I'm going to tell a story for the company. And remember, you're trying to tell a business story, not writing a creative novel. So don't create characters because you think they're interesting. Don't have any three-headed dogs guarding entrances to attics or something. This is something where you have to be full. So when you tell a business story, my advice is, first, keep it simple. Here's what I don't want to see as your story. I don't want Game of Thrones. Right? You don't have 8 seasons and 80 episodes to tell your story. You have like 15 minutes. Keep it focused. What's the end game for every business story? What do you have to convince me as an investor? That you found a pathway, you're looking at a pathway to making money. Is that asking for too much? Be surprised how many startup stories I listen to, but somebody, usually a geek, has come up with this great app, an amazing app, look how many downloads. Finally put up and say, how do you plan to make money? Looks at you like you have two heads. Let me go back and tell you how interesting the app is. At least tell me you thought about the possibility of making money. Keep it focused. And third, stay grounded in reality. Content fairy tales. And it's my job to ground you in reality. So think of yourself as a Kevin O'Leary of the startup space. We watched, Shark Tank. And your job is to ask the question, that's nice, but. So here was my Uber story in June of 2013. And I never apologize for stories in hindsight, because you look at it sort of how unrealistic. Based on what I knew in June of 2013, here's the story I told for Uber. I described it as an urban car service company. Already you can see in my story, where do I see it succeeding? In cities and towns as a car service business, which would expand the business by bringing in new users, like who? Like my sons. So it is going to expand the business that you see out there by bringing in users who would not have been part of the car service business prior to Uber coming. Remember, car service has been around as a business for 100 years, right? Taxi cabs dominated, but it's bringing in users. With local networking benefits. I already described what networking benefits are. If Uber becomes the largest ride-sharing company in New York, there's going to be a tipping point where it ends up dominating the market. See, what's the local doing? Well, in my story, Uber can take New York. Lyft can take Chicago, Didi can take Beijing, Grab can take Kuala Lumpur, and Ola can take Mumbai. Different ride-sharing companies, as opposed to a global networking benefit like Google and Facebook have, where you basically dominate the entire market. So in my story, you're going to have multiple ride-sharing companies in different parts of the world dominating each region. I did assume that it could keep doing what it's doing. That 20% is completely arbitrary, right? That they keep. I'm sure that, Travis Kalanick was eating dinner in 2008, and somebody said, what percentage of these fares do you plan to keep? He's writing the tip out. And so, you know what? 20% sounds good. There's no good reason for it, but once it's there, it sticks. I'm going to assume that it's going to stay sticky. And second, that they're going to stay with their existing model of not owning the cars and not hiring the drivers. That's going to become the framework of my story. So now comes the part where I think you need to do a reality. It's easy to tell big stories. In fact, it's easy to get carried away and tell fairy tales. So I have what I call the 3P test. Is it possible? Is it plausible? Is it probable? If you tell impossible stories, you're telling me fairy tales. So first I want to make sure it's possible. And lots of things are possible, right? Somebody's done something like this before. Is it plausible? You need to show me something more. Then it can be done. To show me it's worked in certain parts of the world, and you're going to be. And probable requires even more specificity. I've struggled with explaining the difference, because it sounds like I'm playing on what's possible. So I've wrestled with lots of different ways of explaining. I'll give you the one that I think sticks the best. 2017, I was on a tour of Latin America, talking about narrative and numbers, stories too. And it was hectic. The first day I was in Sao Paulo, Brazil. The second day I was in Santiago, Chile. And the third day I was in Lima, Peru, doing this in each group. So I was wrestling with what can I bring up before 300 Brazilians to illustrate the difference between possible, plausible, and probable. And I want to pick something where every person in the room would have a point of view. So what do you think if you had 300 Brazilians in a room and you wanted to pick one topic where every person in the room would have a strong point of view? What does that be? So it was about 6 months before the World Cup. I said, is it possible that Brazil will win the World Cup? You asked 300 Brazilians 6 months before a World Cup, is it possible that Brazil will win the World Cup? What do you think the answer is? Of course it is. We won it 5 times before. I said, okay. Is it plausible that Brazil will win the World Cup? If I'd asked this question in December of 2014, that room would have been a little shaky. Those of you who follow soccer, there was a World Cup in 2014. It happened to be in Brazil. And there was a semi-final between Brazil and Germany that Brazilians have tried to erase from their memory, right? what is the score again? 8-2? 7-1, so it was a lacking for the ages. But by 2017, they were feeling pretty good about themselves. Yeah, it's plausible. We've got a good team. We're second ranked in the world. We're moving up the rankings. Then I said, is it probable that Brazil will World Cup? And now you can see the cogs. If Neymar stays healthy, if he doesn't flip and flop and do whatever Neymar does on the pitch, and if this happens, then right. You can see with each one, I'm raising the ante. And I think about it the same way. When I hear a startup story, I have to first make sure it's possible. Then I've got to ask the right questions, make sure it passes. And you can see that this is what separates fairy tales from business stories. So I'm going to leave you with some thoughts. You can have impossible stories. You'd be amazed at how many business stories I hear, where I listen to the story and say, I'm not even asking you any questions. This is a fairy tale. Stories like, I can keep growing at 6% a year forever. Okay, nice. Some point in time, you're going to be the global economy, then what? Right? I did an entire piece on fairness opinions in M&A built around the Tesla Solar City merger, where two investment banks had come in with their numbers. And I essentially was very harsh on Evercore for the valuation that they did of Tesla, because it was an exchange offer they to value Tesla. If you've ever seen a fairness opinion, these are kabuki valuation, where banks have to say a deal makes sense. And that valuation, Evercore had estimated a 6% growth rate in Tesla in perpetuity to justify the valuation. My first reaction is, what currency you value Tesla? Argentine pesos? Turned out to be US dollars, 6% growth rate. That's an impossible valuation. Or a valuation that claims that growth can come from being more efficient every year in perpetuity. You can cut costs, but your margin can't exceed 100%. And beyond that, what are you going to do? So impossible valuations are going to be easy to deal with, but when we come back on Wednesday, I'm going to talk about implausible and improbable valuations. And I want you, when you tell the story for your company, to be the harshest critic of your own story that you can be. Ask questions of yourself. Is this possible? Is this plausible? Is this probable? So if you've started your valuation, or better still, done your valuation, take a look at your story and probe for its weakest spots. Not because you want to take it apart, but because your story is only as strong as its weakest links. So on Wednesday, we'll come back and talk about the questions that can allow you to detect what those weakest links are.